Where are interest rates headed in 2024? Now, this is a concern for a lot of people because it affects all sectors of the economy, which we've seen getting really red hot in certain parts, and in others, 13 interest rate rises later have really started to slow things down. So in this video, we're going to explore where they're going because there's been a couple of changes in the forecast.
Yeah, Australian economists are actually predicting that the RBA will hold interest rates steady for the year ahead as consumer demand decreases, especially in the services sector.
Tell them to hold steady.
This is a big change for the Reserve Bank, who initially went really hard to get inflation under control. Jayden, we'd love to know what the inflationary projections are for the year ahead and even what the Reserve Bank's approach has been.
Yeah, they've got a pretty blunt mandate. It's to keep core inflation between 2 to 3% in Australia. And the main reason is if inflation keeps going up and up, the price of goods and things get more expensive, and it can cause the economy to a collapse. In an extreme case, hyperinflation is not good for anyone anywhere. So that's why they've tried to put a lid on things. And while inflation peaked at over 7%, economists are now predicting that it's going to get back down to 2.9%, sort of their Goldilocks zone, if you will, by the end of the year, which has happened a lot quicker than what a lot of people are predicting.
Now, the Reserve Bank's actually going to take a more cautious approach to the year ahead. Previously, we saw them quick on the trigger finger to, increase rates here, there, and everywhere, any chance they got to try and snuff out inflation. But based on what we're seeing with the US and other advanced economies, they're all sort of starting to slow down and saying we're going to take a more cautious approach within rate increases from here.
The conditions, though, could change for the Reserve Bank, and I guess the two major things they're looking out for are, firstly, if there's a massive rise or a sustained rise in unemployment. We started to see unemployment rise the latter part of last year, but if there's a big blowout here, they might actually have to bring forward the rate cuts to try and spur some activity there and stop things from slowing down. And secondly, if there's sort of unexpected economic shocks, from things in Russia, obviously there's instability in Gaza and Israel and all those places like that. So if something were to happen, the Chinese property sector, there was flags on that a couple of years ago. It seemed okay, but that's what they'll be looking to look out for.
And there was a survey recently completed with economists predicting that there's going to be rate cuts happening as early as September this year, while bond traders are foreseeing rate reductions to start as early as June. So we're actually starting to see some of the markets shifting on where they think rates are going to be this year. The Australian economy has also shown signs of starting to slow down. We've seen minimal wage growth, or minimal growth in the economy, I should say, for the quarter ending 3 of last year, and a slight uptick in unemployment, which has increased. And this is suggesting that rate hikes are close to their peak, or maybe one more rate hike in it, and that's about it. So we're getting very close to the peak of the cycle.
Please don't come back again.
Jayden, walk me through the Reserve Bank's institutional changes that we're seeing that might come through this year that might be a positive sign for things to happen.
Yeah, so one of the critiques with the previous governor, Philip Lowe, when he was going around and saying interest rates are going to be on hold until 2024 and there weren't going to be any increases, was a bit of a lack of transparency. You didn't know what individual sort of members of the board were saying and doing, and there was a requirement for meetings 11 months of the year. So they're doing every month except for January. And they're looking at changing things up this year. So they're going to reduce the amount of meetings, because when the Reserve Bank's making calls on these things, they're looking at big trends. They're looking at unemployment. They're looking at consumer price index in different baskets. And you're not getting that data on a daily or weekly basis. It might only get published every quarter. So a meeting every month might not be appropriate. They're going to cut it down to 8 meetings this year to hopefully give them more time to sort of analyze. And they're going to do proper sort of media briefings and probably be a bit more clear on some of the communication there.
I think this is a terrific step in the right direction, especially for the Reserve Bank. For a lot of time previously, they weren't even getting inflationary data monthly, which that changed last year with the Australian Bureau of Statistics starting to release that data out monthly. But for a long time, they'd go, every quarter and wait for the next inflationary read, and flying blind for a lot of the time where they're trying to get the economy in that sweet spot, and they didn't have the right tools and the right actions to really make things happen. So giving less time between meetings will mean that or more time between meetings, I should say, gives them more ability to wait for that data to come through. They're not getting pressed to make these big changes unnecessarily when, as they talk about those lagging effects in the economy, once those rate increases happen, they can take a while to trickle through.
Yeah. And interestingly, Australia's economy is different to America, where they've already, in America, flagged this and say, well, potentially there's going to be 3 rate drops this year in America. Our economy structurally is different. The way we have mortgage market, in America, you have a 25, 30-year fixed rate. Here, At best, you'll do a 1 to 5 year fixed rate. Most people on variable rates. So changes to cash policy flow through our economy a lot quicker than in some of those other countries overseas.
Now, Jayden, what, for anyone that's on a fixed rate at the moment, might be on that 4-year fixed rate, a lot of them are ending in 2025 in a year's time, even maybe this year. What can you do if you're currently on a low fixed rate? You're getting worried that you're going to see that your variable rate's going to go up by 4%. Is there anything that you can explain to those listeners or viewers out there to help them through this stage?
Yeah, I think just try and actively look at what you can do. Keep in mind, there's only usually about a month before you can start making changes, because if you try and look at refinance options today when you might not be refinancing until the end of 2024, 2025, it's too soon. There's not much you can do because your home application would expire. So definitely be active on that and hit up a mortgage broker like us to look at that.
And I think it's one of those things, if you're currently on a variable rate and you're finding it really challenging, we know the cost of living's up, electricity costs, everything's up at the moment. So it's a real challenge. Hopefully we do see some reprieve with rate cuts coming through later this year, but it is really dependent on so many different factors. Obviously economic and politically can also have an impact on that. So guys, I think it's one of those things you just want to keep an eye on what's happening, and we hope that rates come down. Jayden, is there any last thoughts before we conclude today?
Yeah, well, money markets are pricing in. This is the people that are trading, futures and stocks and that sort of stuff. They're pricing in 2 rate drops later this year, so 2.25% drops in mid to late 2024. So there's definitely looks like there's potentially some reprieve on its way. If you're looking at buying, I guess the positive on that is you potentially get more borrowing capacity.
Make that money.
A couple of other things that could change will impact this year is there is a federal election due next year in 2025. Famously, when John Howard was in power and Kevin Rudd went in, when the interest rates went up mid-election, he pretty much lost it, and they said, well, that was largely potentially because of that. So it'll be interesting to see what the government does with that, because interest rates and cost of living can win and lose elections. So,
and lastly, I guess between when rates peak and the first rate cut comes through ranges from anywhere from 11 months to 19 months. So if rates did indeed peak from the last rate rise, which was November of last year, on the best case scenario in 11 months time, the first rate cut would be around October this year, or on worst case scenario, sometime mid next year. So it gives us an idea if we are indeed at the peak state based on the previous times where we've seen rates peak and come back down. The period in which between the last rate hike happened and the first rate cut happened was about 11 to 19 months. So something to keep in mind as well with the forecast moving forward. Guys, here at Hunter Galloway, we're mortgage brokers. We deal with people Australia-wide. So if you need assistance, you're not too sure about your existing loan, what to do with it, or you're looking to get into the market, we can help. Give us a call on 1300 088 065 or visit our website huntergalloway.com.au. Until next time, guys, thanks for watching.